Hello traders, join us on this short video as we take time to examine the factors that govern the direction or influence the direction of a particular currency at any given time. This video seeks to enlighten the viewer by outlining the reasons why currency pairs tend to trend as exhibited on Forex charts and how traders utilize these factors to their benefit when trading. Kindly remember to subscribe. The Forex market is influenced by a wide range of factors. As you can see on this chart, we have named fundamental factors, technical factors, and market sentiment as key causes of currency fluctuations. Fundamental factors refer to economic and financial variables that influence the value of a currency. Then we have technical factors. Technical factors refer to analysis of price movement and chart patterns to make trading decisions. We also have sentimental or market sentiment. Basically, this is a preview of the market to get a perspective of the direction that the market is taking, so that when you are taking your positions, you can trade alongside other traders, all in the market sentiment bias. So, first and foremost, fundamental factors. They include economic indicators, central bank policies, geopolitical events, market sentiment, interest rate differentials, trade and economic policies, and market interventions, also not forgetting inflation and deflation. So the first, economic indicators. Economic data releases play a significant role in moving the Forex market. Some of the key economic indicators include GDP, inflation rates or CPI, non-farm payrolls or employment data, NFP, and trade balances. Typically, strong economic data leads to currency appreciation, while weak economic data leads to currency depreciation. For example, if a trader is planning to take a position in any pair whose quote involves the US dollar, and there are upcoming news on any of the economic indicators affecting the US dollar, then such a trader should keenly observe whether the news releases affect the dollar positively or negatively. If the impact is positive for the US dollar, then they should take a long position or they should buy the US dollar. And if the impact is negative, then they should take a short position or sell the US dollar. The next is the central bank policies. Central banks such as Federal Reserve in the United States, Bank of Japan, Bank of England, and the European Central Bank in the Eurozone influence Forex market through monetary policy decisions. Decisions on interest rates, monetary easing, or monetary tightening programs can impact the currency or the price of currencies. Typically, when a central bank raises interest rates, the currency affected by the decision will either rise or fall depending with the decision of the central bank. So the third fundamental factor are geopolitical events. Such events we are talking about, like the crisis, right now the crisis between Israel and Hamas, or the crisis between Russia and Ukraine. Typically, political instabilities, elections, and geopolitical developments have a huge impact on how the affected currency fluctuates. Uncertainty or conflict can lead to safe haven currencies like the US dollar and Swiss franc strengthening. For example, as we have said, Russia launched a large-scale invasion of Ukraine on February 2022. As a result, the stock market and related currencies such as euro declined immediately and continued to fall sharply for the next months. The other fundamental factor is trade and economic policies. Trade policies and trade relations between countries can impact currency values. Tariffs, trade agreements, and trade disputes can affect export and import dynamics, thereby influencing the exchange rate of a currency. Then we have the other factor in interest rate differentials. Differences in interest rates between countries can attract investors seeking higher yields. Currencies from countries with higher interest rates may appreciate as a result. Then let us look at another factor, market intervention. Some governments and central banks may intervene in forex market to stabilize or manipulate their currency value. Such interventions can have a temporary impact on the exchange rate. For example, when we talk about market interventions in the present day, we all know each and every day we are waking up to news that the Bank of Japan is likely to intervene on the USD Japanese yen pair. This is because, or it has been observed that whenever the price of USD Japanese pair reaches 150, then the Bank of Japan usually comes in to try and stabilize before the yen falls too much against the dollar. So basically, what usually a trader does is, like in the recent days, traders are very worried so that they do not take long position on USD Japanese yen, since the Bank of Japan is likely to intervene and result in a fall in the price, unlike the movement in other currencies. So the other factor that we have not looked at, inflation and deflation. Typically, inflation erodes the purchasing power of a currency, while deflation increases its value. Central banks aim to maintain stable prices, and changes in these rates can influence the currency values. The next item we'll be looking at the other category, the technical factors. So some of the technical factors that we'll be looking at include support and resistance. Typically, one thing that is very common with any trader is that there is a high expectation that market will tend to bounce at support and resistance level, so that when it hits the support level, it will bounce upwards, while when it hits the resistance level, it is likely to fall. So a technical trader will basically take a position or a short position, or rather, technical analysis identifies key support and resistance levels in currency pairs. Breakouts or reversals at these levels can trigger significant price movement. Usually, technical traders will buy a currency pair when it reaches the support level and sell at the resistance level, and more so when the market is trending in a range. Similarly, they'll also buy or sell when the price of a currency breaches the key levels to profit as it assumes the new market trend. So the next technical factor are chart patterns. There are various traders that can use chart patterns like head and shoulders, double tops and bottoms, and triangles to make predictions about future price movements. So what we are saying is that there are various chart patterns but some of the common are just the ones that we have listed: the head and shoulders, double tops and bottoms, and then triangles, which technical traders will use to predict or to speculate the direction that the market may be taking once it hits such levels. So another technical factor is the trading volume. Trading volume usually provides insight to market participants and the strength of price movements. So market participants can be able to get an insight depending on the volume that is available in the market and how strong such prices are. When they take a perspective on such, then they might decide that whether they are going to buy or they are going to sell, depending on the volume that appears to be available in the market. As such, it's noted that high volume often confirms the validity of a price trend. So when there is high volume, then a technical trader is likely to buy such a currency. Then the next technical factor is the market sentiment indicators. Tools like Commitment of Traders (COT) report usually provide information on the position of institutional and retail traders, allowing traders to gauge market sentiment. Rather, what you are saying is that generally technical traders will observe such data as the Commitment of Traders report to be able to gauge how retail traders are positioned and how institutional traders are positioned, after which they will be able to gauge the market sentiment and take their position depending on the information that they get from the COT report. Finally, the final technical factor is the Fibonacci retracement levels. Fibonacci retracement levels. The Fibonacci retracement levels are usually used to identify potential areas of support and resistance based on historic price movements. So as we conclude, it is important to note that Forex market is highly complex and can be influenced by multiple factors simultaneously. Traders often use a combination of both fundamental and technical factors or fundamental and technical analysis to make informed trading decisions. Additionally, market sentiment and speculations play a significant role, so staying informed and remaining adaptable is essential for success in Forex trading. The bottom line is, whether you are a fundamental trader or a technical trader, somehow you have to be aware of the levels we are at. Sometimes we'll be at, the market will be at a significant psychological level, a significant technical level, or a significant Fibonacci retracement level. So that when you are trading, whether you are in either category, you have to incorporate all those factors together if you want to succeed in trading. You might decide you are a technical trader, but then there are significant data releases that command the market to take a certain direction for the next days or weeks, and you might end up losing a huge amount of capital. So it is important to also be wary or be keen on fundamental factors, even if you are a technical trader. Thank you for watching. We will meet again as we continue to learn much more on Forex trading. Thank you.